So today we're going to be going over the accounting break-even versus cash break-even analysis. The accounting break-even analysis involves determining the level of sales necessary to cover the total fixed costs, that is, both cash fixed costs and depreciation. We decompose production costs into two components. Those are fixed costs and variable costs. The accounting break-even point is the level of sales that is necessary to cover both variable and total fixed costs, such as the net operating income, and that is equal to 0. A solution strategy when it comes to determining the accounting break-even quantity. We use the following equation. That is Q equals F divided by P minus V. So some of those would be F, where that is the total fixed costs, P is sale price per unit, and then V is the variable cost per unit. On to the cash break-even analysis. The cash break-even point tells us the level of sales where we have covered our cash fixed costs, so ignoring depreciation, and as a result, our cash flow is 0. Overall, the cash break-even point shows a firm's minimum amount of revenue from sales that are required to provide the business with positive cash flow. A cash break-even analysis starts with the cash break-even point equation. To calculate, start with the company's fixed costs, such as subtracting depreciation. Take this result and divide it by the contribution margin per unit. The contribution margin is equal to the sales price for 1 unit of product minus the variable costs needed to produce that unit. Most companies have a limited amount of available cash. Additionally, holding on to excess cash requires companies to pass on other opportunities that may be lucrative, which costs the company money lost in opportunities if it continues holding on to the cash. With cash break-even analysis, a company can find the volume of sales it needs to generate to cover all of its cash expenses during a given period. A cash break-even analysis uses an equation that is similar to standard break-even calculation. The difference is that the cash break-even analysis removes non-cash expenses, causing a different result and providing analysts with additional insight into a firm's financial condition.